I think I had too much coffee today. I think that's what it
Yeah,
is.
you were gassed, man.
And what's funny, my coffee cup is, I've only had literally like a couple of sips of it. Welcome back to the issue at hand. I'm Chris Aleman, and I'm joined here by Mike Sanders, fresh off his fishing trip in the Great White North in Canada. How you doing, man? How was it?
Wow, it was good. It was good. Didn't get hooked by any of my kids, so that was a positive.
Oh,
and
that's
it was
always a
fun.
winner. That was one of my traumatic stories when I was 6 years old, is having a treble hook in my thumb. So I appreciate that.
Yeah. I lucked out.
Well, all right, let's get started. In this episode, what I wanted to discuss with you was, I think what investors are looking at was the recent jump in Treasury rates, but specifically what's been driving it. I know everybody's been talking about it. There's a lot of things kind of out there, and I want to talk about the factors that are going into it. And one thing that I'm personally curious about that I hope you touch on is going to be oil. Not only, I guess, at the pump, what I think most people are concerned about, but also the refining, how, diminished global refining capacity has led to the price increases of things we never think about: fertilizer, petrochemicals, polymers, aviation, logistics, stuff like that, stuff that we don't normally talk about. And I'm curious about that one. Now, I know oil is only part of the story, so I think one of the things that I'd like you to start with is, let's take a step back and go to the basics. How does one go about, how do you go about determining where the 10-year Treasury should be?
Yeah, good question. I mean, there's a lot of items that go into kind of where a 10-year Treasury should be, right? It's growth and inflation at a basic level. So expected economic growth is kind of where inflation is. You can also add in, items you hear about like term premium. You think about where near-term Fed funds policy rates might be going. You have fiscal issues as well, foreign demand. So it's a little bit of everything, but, at certain points in time, maybe one item might be more important than others. And I think, recently we have seen the uptick in oil, and that's definitely helped push rates higher as inflation expectations have risen, and, it's definitely moving the market.
Well, you brought in something about the Fed and, what they're kind of looking for. And I know on some of these things we discussed what their mandate is to keep inflation down. And we've heard the press conferences, we've heard the tough talk on inflation. But I guess relating to this, what are they doing to address it? And does your formula that you kind of just laid out, does that still fit today?
Yeah, they didn't do anything to address it yesterday, which was the interesting outcome of that meeting. Not that we expected them, I guess, to hike, but Warsh definitely has shifted a little bit, it seems like, in terms of how hawkish he is about getting inflation down. And so, what's been happening in the near term is with respect to Fed policy and how that's impacting the back end is that, hikes were priced in, and it seemed to be that Warsh was a little bit less willing to hike. At least that's what the perception is right now.
Yep.
And therefore the inflation side and fighting the inflation on the longer run, that thought was reduced. And so the market started to call his bluff. And that's why you saw the 30-year Treasury was high it's been since 2008, over 5.2%. And that's, a lot of it has to do, if you're a long-term bondholder, you don't like inflation. And any sort of hesitancy by the Fed is going to cause issues.
I mean, I have a feeling that any word that's going to be coming out is going to be highly scrutinized now because we're not getting as much information. So, yeah, that makes sense. I guess the other thing that I had touched on briefly in the intro was oil and how it's impacted, I guess, on the 10-year Treasury or even the 30-year, all Treasury yields. But how interrelated, I guess, is the price of oil to the recent movement?
Yeah, I mean, it definitely matters. It also matters about kind of the refined products that you had mentioned as well. So it's one part of the equation when you think about trying to explain the movements in the 10-year. And you're getting this interesting interaction between a new Fed chair, higher energy prices, the inflation target of 2% PCE core has not been achieved for a long time. And so it's definitely getting focused on a lot in the context of where we have been and where we probably are going to go in the near term in terms of inflation and how serious Warsh is and the FOMC to fight it.
Well, I think that's an important thing that you mentioned, though, is that it is one thing. So even if oil goes up or down, it's still one thing of many things to be considering. So it's not going to be tied to it. But I guess, in your opinion, what is a potential catalyst that we can get maybe the Treasury rates down a little bit, specifically the 10-year down?
Yeah, I mean, any sort of reduction in what's going on in the Middle East will definitely help. Lower oil prices will definitely cause Treasury yields to fall. I think any sort of commentary from Fed officials over the coming weeks to talk about inflation, talk about the commitment to it, what they're thinking in terms of hikes. I think all of that more hawkish commentary from the Fed will also be a big indicator. So if I was going to try to figure out, sitting in a chair of what items would be most important, I think oil in the Middle East, Fed officials being more hawkish, and maybe less so fiscal policy at the moment. That's not going to change very quickly, but longer run, it's going to really, really matter.
No, that's an important point. And I think one of the last things I wanted to touch on was when we talk about the 10-year and we talk about the movements, et cetera, we also want to discuss, is it even fairly valued? Do you think that it's fairly valued where the 10-year is currently? And if not, if so, are there other opportunities that you're looking at along the curve that you see as more valuable?
Yeah, I think, it's always tough to say fair value, for sure cheap. I think if you look at positioning across the curve, I do think that, there's a lot of uncertainty out the curve, all the items that we've discussed. And I do think the belly of the yield curve, which, generally is that 2 to 7 year part of the curve. If you think about if you're a bond investor and you want to earn some income, but maybe reduce the possibility of price impacts you might have with longer bonds, that'd be a great spot to invest and kind of wait to see what happens out the curve.
Well, then I guess if I can recap kind of what I'm hearing is that when yields move higher or lower, don't always assume it's one thing. Don't always assume it's either inflation or just Fed policy or just oil. There's always more to it. And I think the second thing that I think it's important for everybody to understand here is also, I think I gathered that yield curve positioning matters. And I want you to touch on that a little bit more.
Yeah, the highest yield doesn't necessarily mean it's the best investment, right? There's reasons that yields go higher, if you will, and there's reasons that parts of the yield curve are higher than where they are shorter in duration if you're shorter maturity. So positioning really, really matters. If you were owning a lot of 30-year bonds recently, you've taken a price hit to it because of kind of all the items that we've discussed. While shorter maturity bonds like the 5-year have went down, but not nearly to the extent. So it really does matter positioning across the curve, and buying the highest yield, I think, gets investors sometimes into trouble in different periods of time.
Yeah, I think it's one of those things. Don't always just stretch. Make sure you know where you own and make sure you know where position you're comfortable with. So I think it's an important point to hit, and I think it's the point where we should close it out here.
Sounds
so
good.
If you want to access additional information and disclosures about the issue at hand, please visit MadisonInvestments.com. And if you like what you're hearing, don't forget to click subscribe. Thank you and take care.